Alright, today we're going to look at the balance sheet and what is included in the classified balance sheet on our financial statements. So we know the balance sheet is going to equal our assets, liabilities, and owner's equity. Those are the three types of accounts that we are going to have. Another important thing to note about this is that the balance sheet is as of a particular date, usually December 31st if they follow a traditional fiscal year. This is because we are going to give the account balances at a specific point in time rather than showing how they change throughout the year. So the first thing we're going to look at are our assets. Okay, remember our assets are things that we purchase in order to gain some sort of future economic benefit. So we purchase inventory so that we can sell it, we buy machines so that we can acquire something else, and buildings so that we can support all of our different sales. So these assets we're going to break down into two separate categories. So on a classified balance sheet, we're going to break down our assets into current assets as well as non-current assets. Current assets are things that we can easily liquidate or that we can convert into cash within the current period. Typically in US GAAP, these are ordered in the order of liquidity, so the most liquid assets appear first. This would include cash and cash equivalents, which include things like checks and money orders. Then we're going to look at short-term investments, so investments that we purchase from other companies, stock in other companies that we expect to sell at a profit in the short term. We include accounts receivable, which are basically sales on account for our customers. And sometimes this accounts receivable will be given with an allowance for doubtful accounts. And oftentimes in financial statements we may see the net value of those. So if you see just accounts receivable, it will typically be accounts receivable minus the allowance for doubtful accounts. Then we go into inventory, and there are three different categories of inventory. Usually they're all rolled up into one, but if we're a manufacturing company, this will include our finished goods, as well as our work in process, and raw materials. Finally, we'll wrap up our current expenses with our prepaid expenses. Finally, we'll wrap up our current assets with our prepaid expenses. So these would be things like interest, insurance, etc. that we have paid in advance. An interesting note, so typically under US GAAP, we put the more liquid assets at the top and the least liquid assets towards the bottom. Under IFRS, however, IFRS lists them in the opposite order. So typically cash would go at the bottom and then all the way up to prepaid expenses and so forth. So just something to keep in mind. So our non-current assets will be the rest of these different asset accounts. So these would be things like investments that we expect to hold long term, property, plant, and equipment, and this will typically be net of depreciation, and then other assets. So these could be things like intangible assets, patents, trademarks, and so forth, and so forth. So with these assets, we have our current assets, non-current assets, and we would take each of these different items, list the holding value of these on our books, and come up with a total value for each of these subcategories in order to come up with our total assets. Okay. Next section that we have will be our liabilities. Okay, so liabilities are obligations that we have to other parties. Just like with the assets, we're going to classify these into current liabilities and long-term liabilities. So our current liabilities would include accounts like accounts payable is the most popular one. So this is money that we owe to suppliers. We would also have current portions of notes payable. So these would be extended loans that we have contractual agreements for that are due this year or in the current period. We have our unearned revenue, and other accrued payables that we haven't included before. So these would be things like interest payable, insurance, and so forth, where we've used up some expense but we haven't paid for those at this point. Under long-term liability, we're going to include notes payable, which would include obligations that are due in a period that is longer than the current year. And that's essentially what we're going to see in the liabilities section. So the final section that we're going to see is owner's equity. Okay, so this shows the value that ownership is invested in the company and that the owners are increasing or decreasing as they have increased net income and so forth. So stockholders' equity or owner's equity, the major accounts that we have include common stock, which usually has the number of shares outstanding, and a par value, which is usually $1 or 1 cent. We have additional paid-in capital. Which is how much investors have paid beyond that par value, because we expect that shares will sell for more than $1 or a penny. So that additional paid-in capital is recorded here. We also have treasury stock, which is stock that the company has repurchased from their investors. And finally, we have retained earnings, which is our accumulation of net income and dividends. Also, depending on how the company decides to present their financial statements, they may include other comprehensive income. Also, depending on how the company presents their financial statements, they may also include other comprehensive income as part of this statement. So if we look at this all together, the balance sheet breaks down fairly simplistically. One more time, just a quick review. Balance sheet, remember that it is as of a certain date. We have our assets, which include current assets and non-current assets. We have our liabilities, which include current liabilities and long-term liabilities, or non-current liabilities, and owner's equity. With any of these financial statements, you're going to see that companies will use different terms depending on what they've used in the past. So you may have some inconsistency in the particular terms that you see. So you may see owner's equity, you may see stockholders' equity. Liability is pretty straightforward. Assets and current assets, you may see non-current or long-term assets listed there. And sometimes they will take accounts and they will net the value. So where you see the net, you have to allow for any of these contra asset accounts as well.